Hi, my name's Luni. You saw me this morning, and I said I wore a lot of hats and a lot of shirts, so I have a different brand on right now. My day job is running Fledge, the Conscious Company Accelerator, and in about an hour, I'll tell you what that is. This talk in particular is what I call "You're Doing It Wrong." Right? It's an explanation of why people think the way they do when it comes to investing in early stage companies, right, in private companies. And the reason they do it this way dates back to this book. Does anybody recognize this book? Has anybody read it? I love when I do this because it's like 3 or 4 people in the audience. It's actually a history of science book. It's written by a philosopher, right? It's the structure of scientific revolutions. It's like 50 years old. And everyone in the audience actually knows what's in this book, right? Because this is the book that invented the word paradigm. Right, and what a paradigm is for real, not the normal use, but the real use as defined by Thomas Kuhn is a bunch of ideas. So you have within science a bunch of ideas that explains the universe. And when you run an experiment and the result doesn't fit those ideas, you ignore it. You don't embrace it. You don't change. You actually just ignore it. And the same thing happens when you have the paradigm in, let's say, politics. No, that can't possibly be true. I'm just going to ignore that fact, right? And the same thing's true in investing. When something comes along and it just doesn't fit, you might nod in the room today, and then you're going to go home and you're going to fall back into the old paradigm, right? Unless you keep in mind that you're stuck in a paradigm. Because what happens in real life, in science, again, according to Thomas Kuhn, is enough evidence comes forth that says this paradigm you're working with is wrong, and then it shifts. And so we've seen this, right? Newtonian physics turned into Einsteinian physics. Newtonian wasn't wrong completely, it's just wrong in some areas, and we adopted this new idea. And we think that's true, and it's true enough, but something will come along in 50, 100, 200 years, and we'll throw that out and we'll shift to something else. All right, so the antidote to the paradigm of early stage investing is this, right? So I wrote down a longer version of this talk. It's in the form of a book. You can buy it up front, or you can go and get it on Amazon if you don't want it today. It goes something like this. In the US, each year, more than 500,000 companies get started each year. The number is something like 560, 580. It's actually been trending slowly downward, but let's just call it 500,000 because that's a nice round number. 500,000 companies. Now, not all of them are expecting venture capital, but a lot of them are. In 2016, only 4,115 companies got a venture capital investment for the first time. That's it, 4,115. Maybe it sounds like a lot, but remember, it's 500,000 companies. Now, every single one of those investments made by a venture capital fund was expected to return something huge. That's what VCs do. Right? And it was the same in 2015 when they made the 4,000 investments then, and it was the same in 2013 and 2012 and all the way back to the beginning of VC land. But only 726 that year had a good positive exit. So that's less than 1% of all companies got venture capital, and less than 0.1% had a big exit. And yet all the investments we do in early stage companies are always talked about in the form that VCs do. We always talk about, not me, but everyone else, we always talk about the exit. What is the exit going to be when that is something that almost no companies do? So when I started Fledge, I said, I can't start, it's a business accelerator for socially conscious companies. I can't invest in companies that are never going to exit. That makes no sense. Why would anyone do that? And if I can't invest in the way VCs do, how can I invest? Is there another choice? Right? Well, I'll show you the choice in a second. So what VCs would say to the 492,000 other startups is that they're uninvestable. Right? And maybe you've used that word yourself. It's uninvestable. Well, I'm going to show you. There is no such thing as an uninvestable company. There's your business model as an investor that may make it seem uninvestable, but that's your problem, not their problem. Right? And if you tweak your model, then they all become investable. All right, so again, we're talking about early stage capital here. It's usually called the valley of death, right, for the really early stage. And the way you look at this as a VC, to go back into the paradigm, is, what's the value now, and can the value grow by 10x or more? And if not, it's uninvestable. Like, that's the basic idea. So where does the 10x come from? Why is it 10x? Right? Well, it comes from this. So this is a chart of a successful venture capital portfolio or successful angel portfolio. The chart comes from Jeff Entris. He works other side of the building at Pioneer Square Labs. He's the most prolific investor in Seattle, angel investor. He's probably done 200 and change by now. He talks about this at Alliance of Angels. He teaches this at UW. These are real numbers. Right? So here's what it looks like. For every 10 investments you make as a VC or an angel, one of them will actually return the 10x if you're successful. If you're not successful, you can forget this. It can be all zeros. Right? But if you're successful, 1 out of 10 will get you that 10x or more. And just to be clear, if you get 1 out of 10 returning a 10x, then you have your capital back. You haven't actually made any money. 2 out of 10 will return something good. Right? It's also baseball analogies. I'm going to skip that. But it's good. Let's call it 3x or 5x or 7x, but it's not 10 and it's not 1. It's somewhere in between. So 2 out of 10 can do that. You got a really good portfolio. 3 of them return exactly capital. And the reason they return exactly capital is liquidation preferences. You've asked for the first capital back. And then 4 just go to 0. And they could be 0 because they're 0 as in they're out of business. They could be 0 because they're up and running and stopped growing and they don't have any value anymore as a venture investment. So they might be decent companies, but no longer investable. So that if you do the weighted average, you get 2.3. There's a research report from 2006 written by Rob Wiltbank. It's called Angel Investing in Groups. It was a look at 6,000 angel investments. And if you invested in all of them, you would have done 2.6. So I always call it about 2.5. 2.5 times cash on cash. So just to be clear, we're talking about VC investments where they look at 1,000 deals before they do one, and they're only right 3 out of 10 times. They're wrong 7 out of 10 times. But that's still considered a success as long as they have these numbers. So their goal is not actually 10x. The goal overall is not 10x. The goal from each investment is 10x, but only 1 out of 10 has to hit the goal. Right? The actual goal that they're aiming for is 2.5 times cash on cash, right? 100,000 in, 250,000 out, 100 million in, 250 million out, right? Within 10 years, or 12 years, or something close to that. Because if you do those cash flows, you discover that's about 15%. Could be 20, could be 25 if it's a 12x or 15x, right? Somewhere in the range of 15 to 25%. And the reason why you want a 15% return is because what you're really trying to do, the real underlying truth here is you're just trying to beat the S&P 500. Because if you can't do that, why on earth are you investing in startups? You should just put your money in the S&P 500 and go have vacations. It's way easier. All right, so we're told within this paradigm that there's only 2 ways to invest in companies. First one's debt. You can do this really easy, right? You hand some money to the company, that's a green bar, and they promise you a bunch of payments. Those are the orange bars. Generally the same payment every month or every quarter or every year, whatever. And the problem is that for early companies, they don't have any revenues and profits. They can't actually pay that. They can't pay you the first payments, and therefore it's unaffordable to them. And so since it's unaffordable to them, it doesn't work for you, and therefore it doesn't work, right? And if you try and get 15% out of the ones that succeeded, if only 3 out of 10 are going to succeed, then you can't charge them 15%. You have to charge them 250%, and then they can't afford any of the payments. So what do? Well, we go back to the tried and true, preferred equity. And I always found this to be weird. I started out as an entrepreneur, and I thought it was great as an entrepreneur because the investor hands you money, and you basically promise them nothing. You promise not to pay them. No, this is a growth company. We're not going to pay you any dividends. So we promise to pay you nothing. We don't promise any specific date in the future when you will ever see any money back. Does it sound familiar? Right? And you hope, and they hope that someday someone wants to buy this company for more than the investors put their money in for, and then you cash out. So we have an unknown period of time, which makes it really hard to know, are you going to get that 15% return on investment or that magical 10x? Right? And these days, it just takes longer and longer than it used to, if ever. So that's where we're stuck, right? So there's no third way, right? There's no other way to invest in startups, except there is. And so here in Seattle, we call this revenue-based investing. On the East Coast and pretty much everywhere else in the world is royalty-based investing. I use the term revenue-based, as does Lighter Capital and some others, because it's all wrapped around revenues, right? We're not writing books here or making movies. We're making companies, they have revenues. And the terms are really simple. It's not complicated. Investor hands over money, and in exchange, the company promises to pay a percentage of their revenues back to that investor until a certain amount of money is paid back. That's it. So let me drop out of hypotheticals. Take a revenue-based loan, for instance. You can do this as loan or equity. I'll show you both. So in a revenue-based loan, you make an investment. All the bold things are variables here. So $100,000, let's say. Nice round number. And the company promises to pay back 5% of their revenues, generally top-line revenues, because they're undisputable. Right? Top-line revenues, 5% on a monthly basis until they've gotten $200,000 paid back. And then the loan is paid back. And I call it a loan, but it doesn't have a date on it, and it doesn't have an interest rate on it. But you can structure it as a loan nonetheless. At Fledge, we do a variant on this called revenue-based equity. So imagine, we usually don't do $100,000, but just to keep it simple, $100,000 buys a certain percentage of the company. In this case, it's 10%. For all of you who do preferred equity, stop thinking about $1 million valuation here, because it's totally irrelevant, right? Put that aside, that you're stuck in the paradigm again. You take 10% because that seems fine. 10% is better than 8% and not as good as 12, but it's a chunk of company. They promise to buy back your shares, either all the shares or half the shares or 3/4 of the shares or one share. That's up to you. They buy back some of your shares for a total of, in this case, $200,000. Well, that's the same exact cash flows as in the loan. $100,000 out, $200,000 in. It's the same 2x. You've played around with some shares while this is going on. And the reason you would do the equity version instead of the debt version is maybe you're wrong. Maybe this isn't a zebra. Maybe this is a unicorn. And maybe they do actually have an acquisition. So if they buy back half your shares and you got a 2x on that, there's some upside. Or maybe this is a lifestyle company that grows to a nice size that someday will pay its founders dividends, and you can get a stream of dividends off of that. Maybe you just think this might grow and you have no idea how big it can grow, and so you just want some potential upside lying around. So that's one reason why we do the equity form. Other reason is taxes. Capital gains taxes are lower at the moment, as far as we can tell, than interest expenses, interest income. All right, so when you put one of these together, and you will in a moment put one of these together, there's really just two variables to play with. What percentage of revenues is the company going to share? And what is the multiple that you want back? You can, again, you choose debt or equity. You can choose residual equity, or if you want, you can do warrants. You can make the repayments optional. We've seen that a few times. And you can add any other preference you've ever seen in any early stage deal to this. So you can do a liquidation preference, which we do at Fledge. You can do a right of first refusal. You can have a board seat. Right? Every preference you're used to, you can tack that on as well. And if you do that, you will discover that every one of those 500,000 companies at some level of investment is suddenly investable. If you believe they can make revenues, I don't say profits, you can believe they can earn revenues from customers, they are suddenly investable. And for all of you, we had a lot of talk about philanthropy today. This works in a nonprofit too. There's nothing that says a revenue-generating nonprofit couldn't sign one of these and share some of their revenues as well. So it works not only in the for-profit world, but in the nonprofit world. All right, so we're going to make little groups and put them together. And we're going to actually move the chairs to make little groups of 4s and 5s. So what you should talk about in your group is, what return on investment do I want? I'll show you some actual investments so you can have them in your head. How long do you want to wait to get paid back? And what else is important in this deal to you? So I'm going to give you 3 examples. You don't have to pick one in your group. Just whichever one resonates in your head, just keep that one in your head when you're talking about this. First one, and they're all from Fledge. They're all fledglings. First one is Jolex. Real simple. There's 3 million people living in Kampala, Uganda, and there's 1,000 flushable toilets. There are more toilets in CenturyLink Field. So this company is installing and operating toilets in the slums in Kampala. Hicote is teaching small coffee farmers in Nicaragua how to raise bees, because if you put beehives on a coffee farm, you get more coffee. And then they aggregate all the honey, which is all organic, and they ship it out because there's a nice international export market for honey. Or if you don't like international investing, then Zirconia is based here in Seattle, and they have a spray-on coating that makes steel never rust. So, the power towers and all the pipelines and whatnot, once this is up and running, they'll never rust again. All right, so we're going to assume that you like one of those. So you have to believe, whether you like them or not, you have to believe at least one of those you like. You have to believe that you've done the due diligence and it's a good company. You like the team, you like what they're doing. And just for kicks, these aren't real numbers, but we're just going to say, here are the revenue projections for the next 10 years. And of course, if you've done this with early stage companies, it's really rare for them to do a 10-year projection, right? 5 would be the most. So what you do in real life when they give you the 5-year projection is just kind of top it off. Just assume it stops growing. Because if you assume it stops growing, then that's not the worst case, but a bad case. In real life, this is a copy of my spreadsheet. Anyone who wants this after the show, I'm happy to share it. You can email me, looney@investorflow.org or looney@fledge.co. And so the way the spreadsheet works is you stick the revenue projections here, and it computes the growth for you. You put how much you're investing and what your multiple is. Don't stick on 2. 2 is just the number that comes up a lot. And then there's 4 scenarios. What would happen? What would this investment look like if I got 3% or 5% or 7% or 9% of revenues? So these are years, and you can see that if you got 3% of these cash flows, these revenues, you would not make back your 2x. You would only get $193,000 back. So for some of you, you're going, well, that's not bad. That's the 12% IRR, more or less. And you might say that's fine in 10 years. Or you might say that's not. You can jump all the way to 9%, and you can say, well, I get paid back in 6 years. And some of you go, well, 6 years is fine, and some people might go, well, that's still too long. And you can do some in between. There's no rule here that says it has to be an odd number. I just picked 4 that happen to be odd numbers. There's no rule here that says it has to be a round number. It can be 4.6 or 4.2. It could be a 1.75x return at 4.2%. That's totally fine. You can have the percents change over time. I've seen lots of variants here. What we're going to do is you're going to split into, again, groups of 4 or 5. So actually pick up the seats and move them around. I'm going to give you 15 minutes to talk in groups. And you're going to answer the question of how you're going to structure the deal. And then when we're all done, after 15 minutes, one person from each group that wants to present can come up on stage, grab a mic. We're going to just consider this to be a really hot company. So you get one and only one chance to pitch the company on your deal. And I will play the role of the entrepreneur, and I'll give you some feedback on whether I like it or not and why. Right? And I'll use the knowledge I have from doing a lot of these deals before. All right, before we jump, anyone have any questions on that? All right, so the question is, do we believe these numbers? For the sake of the exercise, yes. Let's say these are our numbers, not their numbers. In real life, what you do is you run their numbers, and then you run your numbers, and then you see what the difference is. Yes, Shal? Yeah, so the question is, can you do your multiple or 10 years? So my spreadsheet ends at 10 years because that's how patient I am. Right? I run venture fund and I don't want to make my investors wait for 12 or 15 years. Yeah, it's just a tool. So if you want, I've seen these deals that say, I just want your revenues for 7 years, whatever they are, and then it ends. It doesn't have to be a fixed amount of money. Or it can be a certain amount or a certain time. You can do whatever terms you want. There's no, the nice thing about not playing in a paradigm is there's no norms yet. So anything you guys come up with is good. And I've done this workshop 5 times at 5 different SOCAPs and at a bunch of investor circle events. And every time someone comes up with something interesting and novel. All right, any last questions? Questions? Going once, going twice? All right, split into groups. Okay, before you start, anybody else who wants to come share, come line up over by the podium, just so we can get through them fast. No, not for you.
There we go. Dang, if I'd have known it was optional, I wouldn't have come up. I thought I had to. I thought I'd just like pulling a Band-Aid off, I'd get rid of it fast.
So this is Bill Lemon. Bill Lemon also teaches at Presidio Graduate School. He teaches finance. He sits on the board at E8 Angels. He knows a little bit about investing. So lay it on me.
I know a lot about investing, not so much about exiting. But okay, so of the companies we chose, it was the Honeybees for Coffee Growers company. We looked at that and decided, we think we would want to be debt players there. And we went for 7% of the revenue, optimistically, with very conscious of the fact that we could be, by taking the higher numbers, we're cutting off the company's, or potentially limiting the company's ability to have cash to promote growth. So by effectively maximizing our financial returns, we could be at least cutting into our environmental returns.
Great. So this is the number one objection that I hear in this structure, which is, but you're taking money away from the company and they need money. My response back in general is they pay rent, they pay payroll, they pay phones, they pay everything else. Everything is a cost of doing business. And the one thing we don't think about as a cost of doing business is capital, but it is. And so as long as they can afford 7%, right? And what we didn't do in this exercise, because it's so short, is like, well, we should really look at all their financials and put 7% into their pro forma and see what it does. Like, do they still have money? Right? Is that affordable? But we're just assuming yes in this case. So.
Yeah, are they not breaking even until year 9? I mean, that's probably not affordable.
It's possible. It's possible. All right. And so what's the multiple? How much do you want back?
2x.
2x. Okay.
So that's a nice hefty 21.2%.
If it comes through.
If it comes through that way. So of course we're discounting this. Would I expect all 21%?
No. Right. So number one thing you should think of. So thank you, Bill. Number one thing you should think of when you see one of these analysis is don't believe the number that shows up, because nobody ever hits their number. Even if it's your number, it's still probably not the right number. Okay, next up.
Luni, this is Praveen Varshney from Vancouver. Our group is backing the Nicaraguan entrepreneur, which is you, and this is the proposal for you. We're going to go with debt, 5% royalty, but we are going to give you a 6-month holiday on payments to let you ramp up and get the business going. And we're not even going to take equity out of the gate. We're going to actually take some warrants.
Okay.
So we will be able to buy some shares of your company down the road. We'll have to figure out what price that would be.
And you want 2x too?
No. So our royalty is going to be in place in perpetuity until you want to buy it out for $300,000.
Oh, okay. Anybody like that deal? I don't like that deal. All right, so a few things in there. So one we learned, holiday, right, or a honeymoon. That's common. I've done some of those. I personally don't like them. Right? They actually, I do them, but I don't like them. And the reason why is it when you don't do a honeymoon, it teaches the entrepreneur that there's a cost to the capital and they should pay it. And if it's a really early company and then you start doing this when they have no revenues, which is something we do sometimes at Fledge, it's like, I would much rather say, well, look, your revenues were only $1,000 this quarter or this month. Don't pay me. Make it optional. Don't pay me. I don't want to do the paperwork for $100, right, or $50. But I have done the honeymoons because it does also fix the problem that came up with that Bill brought up, which is, but they need the money. So it just leave them the money for a while. So we'll see if anyone else comes up with the optional, but that can come in. The flaw of I want to give you $100,000. You can stop paying me at any time when you give me $300,000, but you owe me until you've accumulated $300,000. That seems a little onerous in the impact world.
Well, if you didn't like that deal, you wouldn't like the last condition, which is we wanted a pound of free honey every year as well.
Yeah, that I've seen too. That's
right.
So, Luni, we were the K team. We had 3 Kathys and 1 Christian in our team. And so it was kind of exciting to talk about this. We didn't see that the company was going to flat out at $1 million in revenue. We decided that the company would continue to grow. And we were into the Ugandan toilets because we figured if they need toilets, they're going to need a lot of toilets. But we also realized we had the same problem with making sure the company could start and have money. So we decided we would do equity because we did think that they were going to get bought out. There are people who buy toilets out there and toilet companies. I mean, we got honey buckets and all those around the world. And so we said that we wanted the 17% return, but we wanted to have a honeymoon period to start. Didn't get the details on the honeymoon period, and that we would then ramp. So start out slower and then ramp up to get the money later on.
okay. So up at past 5% later on, or just?
No, just to make sure that it always got to that 5%.
Okay. And what multiple?
We went with the 2 because we didn't have the numbers to.
Okay. So what you will find when you do this in real life with the spreadsheet in front of you is the number at the bottom here. This is internal rate of return, right? IRR, right? It's approximately what the interest rate would be if you did this as a normal loan. IRR is highly dependent on time, right? One reason why these numbers may look pretty high is because you start getting paid back in year 2 here, at the end of year 1. And so if you take a honeymoon and you take a year or 2,
drop it.
if you take a year or 2 out of this and stick it at the end, the IRR is no longer 17. It's probably more like 9. It drops precipitously.
So we needed the spreadsheet to figure that out.
Yeah, you need the spreadsheet. So what you would probably wind up with is, we'll take 5 for a while and then we'll up it to 7 when you're big enough to.
And we
to
talked
handle it.
about that too.
Yeah.
So thank you.
Okay, thank you.
Hi, my name is Nikki Wilkes. I'm the Executive Director of Journeyman Institute. And we chose to actually use a real live example because I came with a term sheet today that actually has a very similar instrument built in. And we tweaked it a little bit as a group. So our nonprofit has the mission to build compassionate, inspired, and resilient young men through nature-based rites of passage, ongoing mentorship, and community engagement. And right now we're fundraising for a base camp acquisition. So we're looking at purchasing real estate property using impact investing to cover at least half of that. And so our pitch to you, or I guess to me, is to...
I'll play you, you play me.
Great.
Yeah.
I was confused down there as we were role-playing. We want to use a multiplier of 1.5x, and we actually want to tie the rate, the percentage, which we're going to peg at 40, to net income, as opposed to gross revenues. So as a nonprofit, it's very important that we don't feel pressured to cut our costs and sacrifice the programs that we're offering. But we have been successful in generating more revenue than we need each year. So by tying it to net income, we feel good about that, and a higher percentage of that cut going to you after a 2-year honeymoon period.
Okay. All right. So I'm going to switch roles back and play me again. So he brought up the fact that it's net income instead of gross revenue. And so, this setting, that seems fine, right? But if you think good. As you think about it as an investor, The one number you can agree on that actually happened is gross revenue. You can see the bank statement on that, right? Every number below that, you as the investor have no control. Even if you take controlling interest of the board, you still don't have any control on what they spend in terms of expenses. You have no control in the future, what opportunity comes along that they might want to grab. And so there was another structure out in the world discussed called the demand dividend. Anybody ever hear of a demand dividend? They had some great press on that. There was only one that I know of that was ever done, and it was also undone because it was based on not even net income, it was based on free cash flow, which was even more nebulous. And something came along and they wanted to go do it, and they had to like restructure the entire deal to try and figure out what the new numbers were. So the conclusion I have from doing 73 of these now is just gross, right? Let the company run off of that and make sure in the financial modeling that it's affordable. But as an investor, don't ask an investor to try and invest in anything below gross. Right? But thank you. All right, here we got something totally different.
Something different. So I come from the old private equity world, JP Morgan. So I wanted to introduce a little different concept that we almost got to, but not quite. And we chose the private company, the Zirconia, more typically the kind of investment that I'm familiar with at least. I just wanted to give you another view to a possible type of investment that we used a lot, probably over 70 companies, the same structure, convertible preferred equity. So here, this company has perhaps a huge opportunity. You're talking about something technologically interesting, lots of huge possible demand, and so on.
$4 trillion a year
Exactly,
potential
it's
market.
a huge market. So it's the sort of thing that we believe you should want to be an equity investor in. No use being a debt investor here. You want to be an equity investor because the returns could be huge. On the other hand, you're going to be, if you take perhaps 20% of the equity as a convertible preferred, you're not going to be in control of the company. So this is one of the issues that often have, at least in the private equity world, is if you're a non-controlling investor, how do you get that company to realize value for you in a certain time frame? And the time frame we'd like to see the value realized in is something like maximum 6 years. Typical private equity organization likes to have a return to their investors and their funds in a 5-year period. So you're going to shorten up the risk period. But you want the company to grow really strongly in that period of time. So the instrument is structured as convertible preferred equity. It carries a coupon in the normal course of things. Here we might take like a 4% revenue coupon. I'm just assuming this company might have a 30% EBITDA, so dividing by 3, that might be a reasonable amount, but we're not going to require payment every year. We're just going to accumulate that amount every year on top of the value of the preferred equity. Then in year 6, we're going to be working with the company all along. By that time, it's tripled in revenues. Its value ought to be significantly higher. And so we're going to say, look, either we go out for a value realization event, an IPO or a sale to another strategic, or we're at that stage, we're in a position where we could probably go to the normal financing and banking world and put debt on the company, assuming we don't have debt at this stage. And by doing that, you give your preferred investors a payout, probably equal to their entire dividends and maybe 2 times their investment, or at least the base value, or they can convert to equity, which looks quite good at the same time and have a value that way. So it's just a different technique.
Yeah, so it's interesting. The more you dig into this space, the more you find that these things actually exist, right? They just don't exist in early stage venture capital. This structure that I'm showing you today is the normal way to invest in a mine. How many people here have invested in a mine? We got 1, yeah, 2. Or an oil well. The same guy. Or a film in Hollywood, right? That you invest and you get a certain number of points, and a point is a percentage of top line revenue, right? If you're lucky, if it's not net. Okay, next up.
Hi, my name is Eva. I'm here from University of Washington. So our team has entrepreneurs who knew how hard it is at the initial stage of their company. And the last thing we want to do as investors is to withdraw the necessary capital for you to, scale and be successful. So here's our deal. We like to take our multiple is 2x. We like to give you a 2-year honeymoon for you to scale up and to focus on getting customers and expand. In exchange, we would want a slightly higher revenue share at 10%, just to make up for that sweetener. And the equity is what we're going for. So
Okay. Not a bad deal, right? It hits this strange spot of 10%. The only feedback I'm going to give you on this one is there's a company in town. Right? So just to show how common this is, there's a company in town called Lighter Capital. They do revenue-based loans to growth stage tech companies. They do about 4 or 5 a week now. They're the most prolific of its kind in the world. They only do revenue-based loans. They do somewhere between $100,000 and $1 million. And they never break single-digit revenues. So what they've learned out of their hundreds of deals is never ask for more than 9%. So I don't have enough experience. I don't have enough experience to say that 10% is okay. But they've been doing it longer, and they've done way more dollars. And so I never take more than 9%.
Hi there. I'm David, and we opted to look at the B business in Central America as well. We felt that debt would be an appropriate structure to use, and we decided to keep it very simple with one twist. So we're proposing a 5% revenue, 5% of revenue, and we're looking for a 2x return. However, if revenues are generated faster than expected, and you can pay off 1.5x within 5 years, then we're happy with the 1.5x.
Ooh, nice. Okay, I like that twist. That one I have not tried before. So there's an idea. Everyone like that idea? Right? So basically that's saying I'm in it for the IRR, right, more than the multiple. And so when I can get whatever that comes out to be, 15, 20, 17%, if I can get that, I'm happy.
Right, and you're accelerating your impact as well.
Yeah, good. I like it.
Hi, I'm James from the A4 Investment Group. 4 of our names have letter A as the second letter. You're the Zirconium Group, and we're aiming for a 20% IRR with a few twists. We think maybe a step-up function, so 2% the first year, 4% the second year, 6% the third year. And we're going to bring some conditions to this equity, which is a board seat, liquidation preference, anti-dilution clauses, full ratchet. No, I think we said 1x. What did we say? We did weighted average, and we wanted participation in the next round. And here's a twist: we'd like to trade some of the additional equity. We'd like to get some. We could reduce the percentage of revenue with additional equity.
Okay. So basically convertible to preferred shares.
More of a in negotiations, we're willing to discuss those terms.
Okay. All right. Thank you. That was interesting. All right. I'll take the mic. Oh. All right. So that's interesting. Yeah. There's not a single group that came up with the same idea as another group. All right. So again, there's no norms. What I find interesting when I do the workshop is everybody wants to add a twist. I don't, in real life, I try and keep these as simple as possible, but in the workshop, everybody wants to do this and that. Some of the other ones we've tried, one way to get around the question of are these numbers real? We had one deal, we did a revenue-based loan. They said their revenues were going to be X, X1, X2, X3, X, Y, Z, and so forth. We said unlikely. We think they're going to be these numbers. And we did the deal that said, well, if you're right, then you pay us 4% of revenues. And if we're right, you pay us 6%. And so that allowed, and that was a twist, of course, but that allowed us to let hindsight tell us what the risk was instead of foresight, because we didn't know what, with foresight, we were kind of blind. And that company didn't do well. So 6% of nothing is bad. All right. Any last questions before we move on? Yes? Yes. Okay. So the question is, how do you do more than one of these on top of each other? Whether in the scenario presented was, what if it's bad and they need more money? But more money can come when something good happens too. Right. So if they do hit all the numbers and they say, well, we want to be even bigger, we need more money for that. The question is, well, how do you do another one? And so 2 answers to that. One, this is one reason why LIDAR always does single digits, because if you do 5% in this loan and you do 4% in the next, that adds to 9. And now it starts to get a little expensive, but they're addable, right? And if you do 6 in this one, you could do 4 in the next one, maybe. That gets you to 10. What really works in real life is to see that, yes, you were investing on these terms with these expected cash flows, and that was your multiple and your IRR at the end of the day in a certain amount of time. And if we're going to put more money in the company, well, then that money should be growing the company. Otherwise, you wouldn't take it. And if it works out, you should share. You should lower your percentage that you're taking to get the same payout in the same amount of time. And so as soon as you realize that when they add up, you get higher revenues and therefore there's a bigger pie to share, then the right answer is, well, you just sit there with a more complicated spreadsheet and figure out what should the new split be. Right? As long as everybody's happy, you do that. And you can layer on as many as you can, as many as it makes sense for the company. I've also seen traditional debt thrown on after this. As long as it's affordable, it's affordable. I've seen equity show up after these deals. This does not preclude, once you've gone down the path of revenue-based investing, does not preclude you from doing any traditional investing. Because again, most people are stuck in that book, in that paradigm of I need 10x return. Yeah, okay, so how do you stack the seniority? Okay. Every revenue-based loan I've seen has been the junior position. And then, I say there's no norms. That's maybe one of the norms there are, is that this is never senior debt. Doesn't mean it has to stay that way. That's one of the terms that's negotiable. Okay, we got time for 2 questions here. Okay, so the question is, how do you measure, how do you value impact in this deal? Okay, so I'm going to try and summarize that, but the question, I'm going to interpret this question with my for-profit lens to say that if a company is saying that they can do a certain impact at a certain scale, where is the non-profit-seeking money going to come to help make that happen? That's sufficient? Right? Again, from my frame of I'm an impact investor, I make investments in order to both have a return on investment and have an impact in the world. So to me, the way this works out is if it's Jolex in Kampala that is doing work that I don't understand why the government doesn't fund, but needs to get done and their financial model looks decent, maybe I'll take less than a 2x on that deal versus Zirconia, which is going to be an incredibly impactful company, but doesn't have that heart of I'm saving people's lives in the slums in Kampala. And there I'm not going to discount it, and they're going to get 2 or 2.5 times money, right? Or more, right? I may actually only have them buy back a quarter of the money. I just want the capital back. I want all the upside on that one. So to me, as an impact investor, it comes down to what return on investment should be made for this particular investment. And then the other question of where's the rest of the capital? To me, I don't know where the rest of the capital is. I have no control over that capital. I only have control over the little fund that I run. They should be investing in these companies too. And as far as I'm concerned, they should, again, tear up this book and say, well, if this is important to them and their community and their cause, well, maybe they take, I think Stephanie talked about this upstairs earlier today, maybe they should take a 0.8x return because they were going to donate the money. They're going to donate smaller amounts of money. Maybe they should donate larger amounts of money and take a 0.5 or a 0.8 or a 0.9 return, which is a loss, but they have the capital back to go do it again. Don't know. I think blended capital will be happening in the future. That was a long question, so that's going to be the last question of the day. So just a reminder here, that is the paradigm we're all stuck in. That, I think, is the solution. It's a really short book. It's $10. It's on the table outside. And everyone who's not doing this, I think you're doing it wrong. All right.